Good afternoon, everyone. My name is Farzana Hussain, and I am the corporate finance team member at Yobs Beverage. Today, I will be presenting my report and recommendations at this board meeting. So, let us start. And first, we start off with the introduction. So, these are the various financial analysis in this PowerPoint presentation that is specifically prepared for Yobs Beverage. And in this in the introduction, this study is based on the previous financial analysis, which was based on financial ratios, as I have shown earlier. And Yobs Beverage will have to use the marketing strategy and to improve their market control and introduction of free risk assets, creation of portfolio that will maximize return of the shareholder. So over here, during the analysis of the Yob Beverage, it was observed based on the financial ratio, profit margin of 36.84%, current ratio of 0.87 shows that the company is performing positively but slightly below the compared company called Coca-Cola Amatil. On the other side, the return of asset is 21.04%. Return on equity is at 50.09, which indicates positive performance of the company given its size. The study observed the debt equity ratio is at 3.78, which is a reduction from 3.94. The accounting rate of return is 3.65%, which shows positive position of the business. As an upcoming company, Yob Beverage will have to apply both management strategy and market strategy to improve the current position of the company, like investing into risk-free assets, create portfolio that maximizes the return of the investor, take advantage of the demand and supply. This study further seeks into conducting a deeper understanding of the company's financial position and the financial option the company has, which it can take advantage of to improve its financial position. So let us move on to the weighted average cost of capital. So over here you can see the weighted average cost of capital for Yobs Beverage. On December 15th it was 6.8, on December 16th it was 5.76, December 17th 4.77, December 18th 4.34, and December 19th it was 3.48. So weighted average cost of capital basically shows the minimum rate that provides the company's value once invested. When the WACC of the company is high, it means the company is losing its value. So the weighted average cost of capital is an investment tool which shows the minimum rate of return which will provide value to the investor in a company. When the weighted average cost of capital is higher than the return, it shows that Yobs Beverage is sharing the value which is not good for investment. When the weighted average cost of capital is high, it shows highly likely that Yobs Beverage is spending more money raising the capital, and that Yobs Beverage will be at a financial risk. When the weighted average cost of capital is high, Yobs Beverage becomes risky to investment in and shows that it has a very low value investment. And also the data shows that Yobs Beverage might be in a credit risk. Moving on, so this is the chart that I have drawn regarding the weighted average cost of capital for the Yobs Beverage. And as we can see that the weighted average cost of Yobs Beverage is actually falling, and Yobs Beverage got their capital at a lower cost. Financial risk in the company is reducing as the value of the company is increasing. As the debt and equity ratio reduces, the WACC will progressively reduce. Additionally, as the cost of debt reduces, its financial value will also increase. So basically the company should source reduced interest source of fund like shares, non-interest loan. This will increase the value of the company by increasing the equity and reducing its debt. If Jobs Beverage starts investing in non-interest options like shares and non-interest loan, its value will increase. This can be used to create competitive advantage or even gain favorable position to increase their capital through selling of shares, which will be sold at a good price now that Jobs Beverage financial risk is falling. Moving on to the next slide, we call it a call price, which is the Black-Scholes. So Black-Scholes model is a mathematical model for determining the price of option contract, Jones 2020. The model purpose is estimation of the variation of the financial instrument over time. The approach assumes that the instrument have the log normal distribution of the price. The assumption factors in other variables with the aim of determining the call option price. So the assumption is that no dividend paid during lifetime of the option, market is efficient, no transaction cost while buying the option, risk-free rate and volatility of the underlying are constant. So Black-Scholes model of call pricing. Black-Scholes is defined as a price strategy that is used to determine the theoretical value of or the fair price. For the put option or call option that is based on 6 variables like volatility, stock price that underlay, and the type of the option like strike price and various other things. There are some limitations of Black-Scholes model. The model makes assumption of the constant values for the risk-free rates of return and volatility during the option period. In real world, they do not remain constant. The model makes assumption on the continuous and trading that it's costless. This way, the model ignores the liquidity risk and brokerage charge. The model also assumes that the stock price follows the log normal pattern. This way, the strategy ignores the price swing that is caused by demand and supply pattern. Impact the change in valuation due to assumption that there is no dividend payout. Assumes no LA exercises, example fits only European options. The model is unsuitable for American options. Here I have calculated the estimation of the call price through the Black-Scholes model. And we have taken into account the current stock price, the strike price, risk-free interest rate, time to maturity, volatility. Now moving on to the sensitivity analysis. Sensitivity analysis is conducted to understand how the dependent variable will be affected by the change in the independent variable. The investor should conduct the sensitivity analysis with the need to reduce the weighted average cost of capital. Through the analysis, the manager will be able to balance the factors involved, which involves the aim of reducing the value of WACC in the company. Bruce, 2015. So, sensitivity analysis is normally conducted to understand which variable is critical or key to performance of the business. In this case, Jobs Beverage. This is the smallest change which could make the net present value to be zero. In investment, sensitivity analysis should be conducted to show the manager where they should focus to make the business successful. This is done with the understanding of the underlying factors. So this is the sensitivity analysis, and this analysis can show us the long-term growth rate of the company. Sensitivity analysis is used in financial models to determine the different values of independent variable which causes change in the dependent variable. During decision making, the manager can stimulate what input would be preferred to develop a substantive conclusion. With the need to reduce the WACC so that we can give the client a competitive advantage. Now, in case of Jobs Beverage, Jobs can use the sensitivity analysis to understand by what range will the change in the independent variable affect the dependent variable. In our case, the sensitivity analysis will change the debt equity ratios and thus increase the Jobs Beverage performance. Recommendation. To improve the financial position, Jobs the following are recommended. Getting advice from the financial professional, recover the debt balance, reduction of the expense cost, selling all the assets to increase cash flow, consolidate debt, apply new marketing techniques, invest your own money to increase equity, offer additional payment options. So getting advice from financial option, you must have competent financial analysts who are good in projecting the best opportunities to expand the business entity. Advice from the financial experts will help greatly. Recover the debt balance. In case that Yoke is consisting of an existing debt from its customers, must try as much as possible to recover either using debt collectors or they themselves. Reduction of the expense cost. Yops must try by all means to cut all the unnecessary expenditure as to improve its health position in the financial segment. Selling all the assets. Yops can get more cash by selling all the unwanted assets, hence the cash flow will be good. Consolidate debt. Combine all the debt at once and check if Yop can make it into a low fee product or low interest rates. Apply new marketing techniques. Marketing strategies that does not need any money to be applied. Invest your own money. For more profits and generation of income, Yop has to invest on their own money. Keeping track of the cash flow on a weekly basis, try monitoring the cash flow using modern technologies. So the next is the financing option. The financing option for the Yobs Beverage. Corporate bond is one of the most effective ways through which Yobs Beverage can raise the fund to support their project in operations. Corporate bond is effective in the nature that they have lower volatility than the stock and is liquid. It is diverse in the nature that the company can set the interest rate. Thus, they will reduce the weighted average cost of capital in Yobs Beverage. The company should provide bonds which suit their needs in matters interest rate and maturity period. Financing option for Yobs Beverage. Equity financing. Funding the business operation by increasing the equity in the company. The company will create and sell new shares to the other company. The advantage of this option is that no obligation to repay the shareholders. So, and other factors. Equity financing is the second option that the company can use to finance their operation, which involves selling of fresh shares to new investors in the company. The advantage of this option is that no obligation to repay the shareholders. That means the cost of capital is reduced in the company and thus reducing the weighted average cost of capital and also the ratio of debt to equity. The company will also have a chance to increase their operation with no threat of the credit risk and interest rate risk. So what are the factors to consider? The risk that we have to consider the Yobs Beverage. So credit risk, your company is currently running at a very high ratio of the debt to the equity ratio. This means that the company is critically using debt to finance its operations. The company is at risk of the credit, which means that the financial liability caused by the credits may cause downfall of the company. The company should make consideration of reducing the debt in the organization and replace this with equity in financing of the operations. The company should increase the coupon rate, which will improve the flow of cash into the company, and this way the company will be able to reduce the credit. Again, risk to consider. Number one is interest rate risk. It is caused in Yobs Beverage due to the high borrowing to fund the operation. The company's debt equity ratio is 254.19, which means Yobs is highly dependent on the debt. Liquidity risk. This occurs when the business will not be able to meet its short-term financial obligation. This will be caused by the fact that the business is spending more on payment of the interest. So Yobs Beverage will incur high cost of the debt that they use to fund their operation. The reason is because the company uses a conventional loan with very high interest rate and thus they are subject immense liability. With the high debt in the company, it translates to high interest burden. Due to high interest rates subject to their liabilities, the value of bond in the company and fixed income investment will reduce. Jones 2020. Yobs is currently subject to the interest rate risk, which should consider while making key investment decisions. Due to high interest rates, subject to their liabilities, the value of bond in the company and fixed income investment will reduce. Again, Jones 2020. Ethical consideration. During the investment and changing of the capital structure of the company, YOP need to consider some of ethical practices. They include environmental responsibility and ethical decision making. So, as environment responsibility as a producer and marketer of the beverages, YOPs should ensure that their operations are environmental friendly. This includes use of product recycling, plan of their used products like the bottle cans, grain industry, among others. Ethical decision making. The company manager should make decision only that which will bring positive impact to the company. While making decision, the management should make decision based on research data and positive outcome. So in conclusion, based on the research, if YOPs cannot invest in all projects with the positive NPV, net present value, it must ensure that it generates the maximum return per dollar invested. The optimal investment decision for YOPs Beverage is to invest in projects moving from highest profitability index downwards until all the funds have been exhausted. Alternatively, YOPs may limit the fund available for capital investment in order to encourage competition between potential investment projects so that only robust investments are accepted. Thank you.